So hello, everyone. Welcome to this webinar on accelerating climate investment in Africa using structured finance to scale clean energy innovations. My name is Laura Sundblad, and I'm a finance and impact investing advisor at the Power Africa Off-Grid project. We're really pleased to have so many of you today in this webinar to engage with our speakers, who are all leading experts and practitioners in off-grid energy financing on the continent. So before I hand over to Lovemore Seveni, who is the off-grid energy specialist at Power Africa, I just want to highlight a few housekeeping items. So due to the size of this webinar, we will keep all participants on mute for the duration of the session. But we do look forward to your questions and comments via the Q&A box on your Zoom screen, and we have a Q&A session at the end of the webinar. We're also recording this webinar and we'll make it available afterwards so that you can share it with your colleagues or watch on your own time. I think we still have a few participants coming in, but without any further ado, I'll pass the mic over to Lovemore. So Lovemore, the floor is yours.
Okay, great. Thanks, Laura, and hi, everyone. On behalf of Power Africa, I want to welcome you to this timely event, which is co-hosted by the Power Africa Off-Grid project and SunFunder. It is our pleasure to have you here. As Laura mentioned, my name is Lovemore Seveni, and I'm an off-grid energy specialist with Power Africa. For those that are not so familiar with Power Africa is a US government-led initiative that brings together the resources of over 170 public and private sector partners to double access to electricity in sub-Saharan Africa. Our goal is to add more than 30 gigawatts of new electricity generation capacity and also connect 60 million new homes and businesses to cleaner, more reliable power by 2030. So the Power Africa Off-Grid project is a 4-year program that Power Africa launched in November 2018 to accelerate off-grid electrification across sub-Saharan Africa. And it provides technical assistance and targeted grant funding to companies, lenders, investors that are active in the solar home system, mini-grid and productive use sectors, including health facility electrification, which has taken center stage since the advent of COVID-19. So we have our COVID response as part of that. These distributed renewable energies that I mentioned, solar home system, mini grids, as well as productive use of energy, are deployed through customer-centric business models and play a key role in enabling economic development and improved quality of life. We see this with companies that we feature today in this webinar, such as SunCulture's solar irrigation systems, as well as PowerGen's smart solar mini grid, which support farmers, small business owners, families in realizing their ambitions and increasing their incomes. SunFunder, KawiSafi Ventures, and InfraCo Africa are critical partners for off-grid solar companies seeking access to capital to grow their presence across the continent. As we all know, distributed renewables are also essential for climate-positive economic development. According to IRENA, 85% of global power needs will have to be generated by renewables for us to avoid the worst effects of climate change. This will not be possible without reallocating significant financial resources to low carbon technologies. The 2015 Paris Agreement acknowledges this need for investment and calls for making finance follows consistent the pathway towards low greenhouse gas emissions and climate resilient development. The United Nations Intergovernmental Panel on Climate Change also says that an annual investment of $2.4 trillion is needed in the global energy system until 2035 to limit temperature rise to below 1.5 degrees Celsius from pre-industrial levels. President Joe Biden emphasized the need for global collaboration to reach this level of investment at the United Nations General Assembly, by pledging that the United States will double its commitment to climate finance to $11.4 billion per year by 2024. So to expand the energy access and limit global warming, we urgently need to invest in pioneering enterprises that supply clean energy to the continent. According to SE for All, Sustainable Energy for All, the global energy supply urgently requires a $45 billion investment per year between 2020 and 2030 to meet the Sustainable Development Goals number 7 energy access targets. Although philanthropic funding is also needed, most of the investments required can actually provide considerable financial returns to investors, in addition to their strong socio-economic benefit. To achieve this scale of funding, we need innovative financing vehicles that attract diverse investors and lenders with different risk appetites, return preferences, and timelines for investment. Structured finance provides one way to cater for these different preferences that we see. We've also seen that several structured finance transactions in the sector, including those led by speakers on today's webinar, but I think we can do more to scale and standardize these transactions and accelerate the growth of the off-grid sector. From our end as Power Africa, we have supported new structured finance transactions in several ways. One of them is through our what we call the Coin Fund, which is catalyzing off-grid investments grant window, and we are dispersing $1 million in grants to scale structured and syndicated investments with partners such as SunFunder, Nithio, and First Growth Ventures. We have also supported leading off-grid solar companies, including Gilles and Greenlight Planet, to review and negotiate complex legal documents that has helped them to close large syndicated and structured facilities. In terms of COVID-19, Power Africa is also supporting the industry to recover from the effects of this pandemic by providing significant support to the Energy Access Relief Fund, which is an unprecedented partnership of 16 governments, foundations, and investors. Power Africa is proud to have been contributed to the first loss capital, legal support, and also gender strategy. The fund can now start to disperse much-needed loans to off-grid solar companies across the continent, allowing them to continue and expand their important work in providing energy access, creating jobs, and empowering climate-positive development. Power Africa is co-hosting this session to share knowledge and to also hear from off-grid stakeholders about their technical assistance needs and priorities. So we're really looking forward to hearing from you. We are honored that you have joined us today, and I look forward to stimulating discussion and conversation through our panelists and yourselves. Thank you so much. I'll hand over to Laura to introduce our panelists.
Thank you so much, Lovemore. That was really helpful in placing this conversation in the context of the broader global discussion on climate change and how to finance mitigation and adaptation, a conversation which is picking up speed in advance of the COP26 in Glasgow later this year. So next, I would like each of our esteemed panelists to introduce themselves. We'll go in alphabetical order by company. So we'll start with Gilles from InfraCo. And as we complete the introductions at SunFunder, I'll then ask Surabhi and Jemimah to go directly into their presentation, which will highlight what we are talking about when we're talking about structured finance, and also showcase a transformative recent transaction with SunCulture, who's also on our panel today. So I'll hand over to Gilles first to please introduce yourself.
Yes, good afternoon, and thank you very much, Laura. First of all, I hope you can hear me all right. Great. It's a pleasure and a privilege to be able to participate to this event with all these, very interesting and very distinguished panelists. I'll very quickly introduce myself. I'm Gilles Vaes, CEO of InfraCo Africa. We are one of the organizations of the PIDGE Group, Private Infrastructure Development Group. We're headquartered in London with regional offices in Nairobi and Casablanca. And really our mission is to be a co-developer, so a partner of sponsors and project developers at an early stage, providing essentially equity and project development expertise. So I'll stop there.
Thank you, Gilles. Next is Amar.
Thanks, Laura, and thanks everyone for the comments that's just come before. Lovemore, that was a great introduction. It's fantastic to be here. Really, really great to be able to be part of this panel, and very much looking forward to the conversation. So I'm Amar Inamdar. I'm the chief executive of the KawiSafi fund. We're an equity-based fund. We invest in growth companies, early-stage growth companies, right the way across the off-grid ecosystem. So we not only invest in the companies that are delivering solar power into the region, but also those that enable the delivery of solar power, so financing, technology, etc. The ecosystem that enables that set of businesses. We do two things. I mean, I think we're here to make put capital to work with companies in the region. We're based out of Nairobi. We want to help Africa build a low carbon future, and we want to have universal energy access. So that's why we're here, and we're really looking forward to this conversation. Thanks, guys.
Thanks so much, Amar. Then Tobias.
Yeah, thanks, Laura, and very much appreciate the invitation and the chance to speak with these pretty impressive panelists. So. Thank you for that. Quick introduction. My name is Tobias Dekkers. I'm the Chief Business Development Officer at PowerGen, Renewable Energy. We also do two things slightly separate, but we do two things. One is C&I, commercial industrial solar for corporate clients, and the second thing is power grid projects. So historically, I think we're most known for building microgrids, and now trying to start building a clean energy utility across Africa. Again, appreciate the invite.
Thank you so much. Samir?
Thank you as well for having me and for all the support from everyone we've gotten on this panel. SunCulture is a climate tech platform for emerging markets. We bring affordable and renewable energy to smallholder farmers to help them become resilient to the effects of climate change. And looking forward to talking about our partnership with SunFunder later on the call.
Thanks, Samir. Jemimah?
Thank you, Laura. So my name is Jemimah Kwakye-Fosu. I work as an investment officer with SunFunder, helping to build the solar home system and C&I portfolio here in Africa. And I have over 10 years of working experience in debt and structured financing, as well as consumer data and analytics. And I will briefly be talking about our work with SunCulture also today.
Wonderful. And Surabhi?
Hi, so thank you again for inviting us to participate in this discussion and to be a part of this esteemed group of panelists. I think it is really exciting to be talking about this at this stage because the sector is I think at a tipping point. SunFunder, so I'm the head of investments at SunFunder. Our responsibility is to provide debt financing to solar and storage companies across sub-Saharan Africa. If we can move to the next slide, please, because of course I have to do the shameless plug of who we are. We, so far to date, have closed $150 million worth of loans to 57 borrowers, and we're actually in the midst of raising a $500 million fund, not only to focus on solar and storage, but broader climate technologies and in new geographies in Africa, Asia, and Latin America. The goal is really to address two key challenges that Lovemore touched upon. First is energy access, but also addressing climate change. And so we are actually broadening the scope beyond solar and storage to other solutions such as e-mobility, efficient cooling, and so on. But the crux of it is that we want to build off of our experience in distributed renewable energy and really our structured finance expertise. So if we can move on to the next slide, please. What is structured finance? You know, in preparation for this, and even when as a group, as well as myself, you know, we were debating what is actually the definition of structured finance. You know, I realized that in my own career that everything that I've done $12 billion worth of deals have all had the same underlying principles and they all qualify as structured finance. So if we move on to the next slide, please. Basically, it just means different things to different people. You know, you hear, if you Google it, asset-backed securities will come up, derivatives will come up, project finance will pop up. You know, as financiers, we like to try to make ourselves sound smart. So we'll use words like securitization or ring-fenced and so on. But there are some fundamental factors that feed into what is a structured finance facility. And we've used this in our sector simply because they've been the most appropriate solutions for the companies because they haven't reached a certain level of maturity. You know, if we move on to the next slide, please. You know, structured finance is simply secured loans with an additional level of complexity. You know, we cannot wait for the companies like SunCulture and PowerGen to get to the stage of like Apple and Google, where you can just do plain vanilla unsecured financing. But until then, you know, we look at their businesses and try to break it down to these four fundamentals. One, are there cash flows that are predictable? You know, if we talk about the solar home system space or SunCulture's business model, there is a track record to look at of the performance of the payment receivables. And so that is, you know, they enter into contracts with end users who have contractual payment obligations over a period of time. And that's something that we can look to assess, you know, what has been that track record, what has been that history, that performance, and how can we best understand that and predict that over a longer period of time looking forward. Second, is there an identifiable asset? You know, that can be inventory, that can be a system, that can be a mini grid, that can be a portfolio of mini grids. But can it, you know, ring fence, you hear that word, all it means is isolated. Can we actually separate that from something else? You know, we've done this transaction with PowerGen where we provided financing against a results-based financing grant. And we were able to isolate the proceeds from that particular grant. I know I'm rushing through this, but that's because Jemimah's part is a lot more interesting. So trying to just get through the principles of this. Risk allocation. You know, we want the party who's best able to manage and minimize that risk to bear that risk. Again, if we take the case of PowerGen, or if we take the case of mini grids, I am a financier. I have no clue how to build a mini grid, right? So it would make no sense for me to actually manage that risk. Whereas if we look at PowerGen and their significant track record, it makes sense that we rely on them to build the mini grid. Now it's their prerogative whether or not they build the grid or they subcontract certain elements of that. But for us, we would be looking to PowerGen to bear that risk. And then finally, fit for purpose. You know, the facilities when we were designing these facilities, there is a reason behind it. You know, if we're talking about SunCulture, a really strong company, a promising company that has a growing working capital need. So how can we structure something, and Jemimah will get into this, how do we structure something that enables SunCulture to scale while still responsibly managing their treasury and their financial management? You know, for PowerGen, you know, there will be a number of projects that they need financing, and eventually they can't put everything on their balance sheet. So are there ways that we can go about it so that, you know, it enables their growth and still facilitates the goal of building these new projects? That is the intention of how do we put the right pieces in place that really creates that scale for companies that are still young. So with that, like I said, Jemimah will be walking us through a more concrete example. So with that, I am going to hand it over to you.
Yeah, thank you, Surabhi, for your presentation and introduction to the topic. I am going to share with you how we have applied this to a recent transaction that I led here at SunFunder, which is the SunCulture transaction, basically. And I know that Samir is better placed to tell us more about what SunCulture does. So I'm going to be very brief and say that SunCulture designs, manufactures, and retail solar-powered irrigation pumps to smallholder farmers using a pay-as-you-grow model. If you can share the next slide, please. Yes, thank you. So basically, like I was saying, SunCulture manufactures and retail solar-powered irrigation pumps to smallholder farmers using the pay-as-you-grow model, which is basically consumer financing to make their products affordable to their consumers in Kenya and other parts of Africa. Now, earlier this year, we closed an 11 million debt facility with the company. And the main purpose of the funding is to provide SunCulture with the needed working capital to purchase these pumps and bring it to market. So the pay-as-you-grow model also means that they need to finance the credit terms they offer to their customers. So there is also the continuous need for funding for them to be able to scale. Now, this facility is a syndicated loan with 5 other lenders, all working with the same agreement and signing on to the same terms and conditions. All the lenders bought into the structure because this is a solid structure, we believe. And it also gives them the ability to scale with the company in the long term, while at the same time reducing the fundraising pressure on SunCulture. Now, in thinking through the structure, we decided with SunCulture, obviously, on a borrowing-based structure where we will be able to increase our financing to the company as they grow. And I'm going to briefly walk you through how the borrowing base works in the next slide. Yeah, next slide, please. So why a borrowing base in the first place? Now, for us, I can say that primarily the purpose of a borrowing base is to size the loan drawdown to the assets. Now, on this slide, you see the company's assets represented by the bigger circle, and then our loan size with the smaller circle. Now, this asset base, which is the bigger circle, could, sorry, just a minute. Now, this asset base, which is the bigger circle, could include the company's inventory, receivables, cash, and other fixed assets. And the loan is sized to these assets because the asset base provides collateral for the lenders. And of course, these assets are discounted using a discount ratio, which is usually based on our analysis of the quality of these assets. If you can move to the next slide. So once the facility in place and we can finance the company can expand their asset base through their business activities, whether it is purchasing more inventory or increasing their receivables books by making their product available to the farmers using the pay-go model, which I explained earlier. So we can move on to the next slide. So basically, what happens is, if you can move to the next slide. No, the slide before, sorry. So what happens is, so this becomes a cycle and an automated process for the company. I think it's the next slide. I'm missing one of my slides, I think. The next one. No, okay. I think there's one more slide that is missing. But basically what happens is it becomes an automated process for growth for the company. And so what happens is they do not have to go through the debt fundraising process every time there's a need for additional debt. This is because as the assets grow, we are also able to increase the loan amount, basically. And this approach provides lenders the ability to grow with the company. Moving on to the next slide and my final slide. So yes, in thinking about how the structure works and tying it in with what Surabhi presented earlier, for us, the common features in this transaction are, first of all, how predictable we were with the structure in terms of how we can predict the cash flows through their receivables book and their basically their pay-go portfolio. The next one is, it is backed by real assets, such as the company's inventory and receivables. And so it provides the needed collateral for the lenders. Now, in terms of risk allocation, during our due diligence review, we got quite comfortable with SunCulture's ability to manage its sales and collections process. Now, in other transactions, we have needed other independent parties to come in and review or advise, for example, on the collections. But we did not have that for this transaction, as SunCulture already has strong processes in place. And so the lender's risk basically is really on SunCulture's ability to perform. And lastly, on the fit for purpose, this structure, we believe, is fit for purpose. And as I mentioned in the previous slide, the structure provides an automated process that ensures that lenders are able to scale with the company, and the client doesn't have to start the lending process all over again when they need a top up. And so they can just, we can just go through the process without having to start the lending process all over again. And so to wrap up, this is a very brief overview of how structured finance transactions can work and the benefits and how we've also applied it to the companies that we work with. Thank you, and back to Laura.
Thank you so much, Surabhi and Jemimah. That was really useful in setting the scene for this conversation and making some of these terms and concepts more concrete and less abstract. And we're fortunate to have Samir from SunCulture here also as a speaker. And I'd like to turn to you, Samir, now to hear, how was this experience for you as the borrower? What were, some of the key challenges and experiences that you had going through this transaction? And obviously, Jemimah highlighted already that this removes the need for constant fundraising. But what are the other drivers that led you to pursue this kind of transaction? We're really curious to hear from your perspective.
Sure, and apologies, I'm in a hotel room right now and the sun just popped out behind a building, so I'm glowing unintentionally. So hopefully it's not too distracting right now. I can't see the screen too well, so if you see me blinking, that's why. But Jemimah already shared a lot of the reasons why this was attractive for us. We're a growing company. The type of business that we operate puts us in a position where the more we grow, the more working capital we need. And it's this odd chicken and egg situation. So the ability to upsize this facility as our business expanded without the requirement for constantly refinancing was hugely important to us for all the reasons including Africa being a very nascent venture market and a lot of first-time investors. Fundraising takes a long time in a lot of respects. The benefit of this facility is that we can upsize our business as we grow, and that's why we chose the borrowing-based calculation. So as our portfolio doubles and our inventory requirement doubles, we don't have to keep getting new financing. And we know right now with this current facility, we can finance our business plan through this year, through most of next year, and we're talking about how to keep expanding this facility. Another reason why we chose this particular structure and this particular syndicate was because of the syndicate. Once we exhaust our committed capital, and once we have this structure that allows us to upsize the facility with minimal disruption, we need to figure out how we're going to fund that. And this is the reason we had a large number of borrowers in our initial facility. So who, on hopefully gaining additional comfort with SunCulture, could expand their commitments. So we've started discussions to do this. And as we look to expand the facility, hopefully these other folks can crowd in as well. I think going forward, and some of the things that we're looking forward to working on with SunFunder, whether it's through this facility or through their next facility, and congratulations on raising the $500 million fund, by the way. That's hugely important for the sector, and really excited that you guys are expanding it outside of just solar and looking more at a broader climate basis. I think that's really cool. Some of the things we'll be looking at is local currency. We know that we mitigate FX through pricing, and we have US denominated distributor sales, but we still have exposure. It's not something that, it's just something that I know everyone talks about, but I think it's important to also just to mention that. We're also going to be looking at ways to lower our financing costs. This is outside of this particular structure, because at the end of the day, that'll be effectively passed on to smallholder farmers. We're still looking forward to financing ourselves in a cheaper way in the long run. And it seems like blended finance is being applied at the fund level for many funds to provide risk mitigations to investors. But we also believe there's an opportunity to apply blended finance to a company level and reduce our borrowing costs, which would then reduce the cost for smallholder farmers. And in one regard, lower costs lead us to believe we would have lower risk to all parties and greater impact achieved. On the other side, there's a nonlinear correlation between lowering the price of the system and the total addressable market. So then the lower price, we can sell more systems, our borrowing base gets higher, we have a larger facility, and sort of everyone is happy and wins there. So those are two of the areas that I wouldn't say are challenges we've had with this particular structure, but as we look to grow and as we look to grow our asset base and our customer base and raise larger facilities, these are the types of tweaks that we'll think we'll be making, because with an $11 million facility, yes, it's important, but as we scale to facilities that are much, much larger and get into the hundreds of millions of dollars, lower cost of capital, local currency, these little tweaks can make or break our ability to scale to a larger market and enter new markets. But really grateful for this opportunity. We've had an amazing experience with the SunFunder team, and just really grateful for the support the SunFunder team and all of our other lenders have provided us through this process. So hopefully we can continue to work with you guys going forward and keep providing you comfort in our abilities to scale this. Thank you.
Thanks so much, Samir. And I think it's only appropriate that you're solar powered, just like your irrigation systems. Oh, it's super interesting to hear how that was for you, and also what you're looking for in future facilities, including local financing and blended finance. And of course, Power Africa and Power Africa Off-Grid Project work with a whole network of donors, lenders, and investors who are listening intently and getting ideas and insights. So thanks so much for sharing. And next we'll hear from Tobias from PowerGen. So obviously with PowerGen working in fully renewable powered mini grids in markets across East and West Africa, including in sort of more frontier markets like Somalia and Sierra Leone. These mini grids have really critical impacts in terms of quality of life, in terms of increased incomes, strengthened livelihoods, not to mention the climate impacts. And of course, PowerGen has found different innovative ways to finance the development of these mini grids, including with SunFunder and with InfraCo. So Tobias, could you talk to us about some of the most interesting transactions that you've been part of? What have been the benefits, the disadvantages, and also the key success factors that have made those transactions happen?
Sure, absolutely. And thanks for that. Appreciate that intro. So since about 2017, we've been looking towards getting our projects off balance sheet and then funding for those projects through specific project financiers. I think the biggest exception to that kind of general rule that we had for the company is the deal that we did with SunFunder, where we did on balance sheet kind of ring fence debt, as Surabhi just explained, which helped us build the grids that we have on the Unilever estate here in Kenya. So we are excited to do that through on balance sheet kind of ring fence debt. Other than that, we've since 2017, the first deal we did was with Cross Boundary, where basically we took ready and commissioned grids and sold them into their fund. They would own those grids for 20 years, and we would sign an operating agreement with them. So we would operate them for 20 years. What that did is basically allowed our corporate equity to be reserved for growth, investing in the team, and kind of making sure we get to the scale at which a utility needs to be. While the capital for the assets is basically sourced different. We've replicated that then, I think, to now all the countries that we're in, with slightly different tastes of like that principle of project finance principle. The second one we did was with InfraCo. One big improvement on the initial kind of structure was that when we did the deal with cross-boundary, the construction we had to finance ourselves, which introduces another kind of funding round, which introduces more investors, complexity, and kind of time. And I think the mandate and the organization of InfraCo allowed us to do develop construction and operations with the same funder. And therefore it created a bit more speed in terms of being able to execute on that project. Since then, I would think we've kind of added that principle through together as well with cross-boundary with other investors, is that we do want to look at decreasing friction and number of fundraisers as much as possible, because ultimately we want to build grids. And even though I like fundraising, there are not that many in our company. So we really do want to focus on, I guess, as less friction as possible. So that means as many phases, development, construction, operations, and as many countries as possible, which is why we're now trying to raise a Pan-African facility that can fund the construction and long-term kind of operations. So those are kind of the deals. There are a few others, so happy to answer any questions if there are on other deals. Recently closed a deal in Nigeria, again, following kind of the same principles of off-balance sheet financing. And so happy to kind of go into more details. I think the biggest benefits of this structure has been, it's just a whole other, like there aren't that many investors interested in the sector. So there are quite a few, but it's still off-grid mini grids where we still have to like prove business case at scale, etc. So they're not that many. So I think what project finance does is it introduces a whole other kind of segment of investors that want to invest directly into projects and are less comfortable doing it through a corporate round at PowerGen. So there are just more investors to invest. And I think we can raise more project financing off balance sheet with a smaller balance sheet ourselves than we would have done otherwise. So I think we wouldn't have been able to raise the 30 million, 40 million on project financing if we had just done everything to our corporate balance sheet. It just increased, I think, our ability to scale up. And again, like I said, the corporate equity that you do raise then, which can typically be harder to raise, is focus on growth, building your company, etc. So I think those are, I guess, the biggest advantages. I don't think it comes without challenges, as the people here that have had to deal with me, because I think two distinct kind of disadvantages of this approach is one, I don't think our CFO is on here, but C probably has the most difficulty of this, because to be serious, like in a very serious way, is this kind of financing leads to corporate and tax complexity. And that has a real impact on how you structure your business, like unforeseen costs, the various amounts of advice that you need that isn't always that clear, because the tax authorities and the tax regulations aren't always, that developed or that clear on what the implications are. So as soon as you start working with so many different entities and so many different jurisdictions, and then different ways of getting paid as a developer, whether it's equity in kind or in cash, or you get material in kind, whatever it is. So that leads to a lot of complexity, I would say, for the organization, and that slows down growth. Like, it's a real hurt on the business. The reason why I call out the CFO is persistent. Recently, I think Capital recently drafted an article that says it's especially hard on your finance department if you expand to many countries, many jurisdictions. And I think I agree. So I think that's a very solid point, and that's why I'm calling out the CFO. The second one is, and I think that's, it's part of the structure, but it's also very much part of our sector. The risk allocation in this contracting, as SunFunder just also describes, isn't always that easy and straightforward. Talking about ourselves, like we've looked at off-balance sheet financing mostly in kind of like solar generation, where operations are relatively straightforward. I guess the operational complexity of doing grid projects, distribution, metering, in-house wiring, customer call center, all of that kind of work brings, a certain kind of mutual interdependence between the project financier and the operator, where decisions on the project ownership side really impacts the operator and vice versa, of course. And I think to a degree that is higher than in sometimes other sectors. And that can make it very hard. Sometimes additionally hard because we work in pretty remote areas that are sometimes hard to reach. So we can, for example, sites in Sierra Leone that we've done, the project that we've done with InfraCo is some sites we can't go to during the raining season. So that can be a month or even 2 months where we can't reach the site. So if you then have to do an operating agreement on diesel usage, uptime, etc., that can be quite hard on who takes the risk on extreme weather. And therefore, I would say the risk allocation discussions during that contracting, I think, are incredibly tough and lead to delays and sometimes, difficult conversations, I guess. So that's a part that we're constantly kind of thinking about, is like, how can we align incentives as much as possible? Whether it's through investments on both sides, like both on the operator and the project side, whether it's finding better, just better solutions, more remote or something like that, remote solutions or something like that. So that's constantly something we're thinking about. So I guess those I would call it, those two kind of disadvantages I would kind of highlight: corporate complexity and tough risk allocation discussions. Then I think your last question was about key success factors, if I'm not mistaken, and correct me if I'm wrong. I think two, I've already kind of mentioned them. One is reduce friction as much as possible and as fewer fundraisers as possible. So find a good group of people that can do multiple phases, which is relevant for us. I'm not sure if it's for all sectors, but construction and long-term operations. It's fine if the investor wants to exit after X amount of years, that's fine. But there's a lot of operational complexity with getting grids to actually being commissioned that you want to do. And then the first few years, you want to do that with one investor, I think. Then gives you a little bit of breathing room to think about next steps. I mean, it was a question for SunCulture, but I think you've already answered it on the growth of it, because I saw quite a few parties to the syndicated loan. So I was impressed because the more investors that you do get, the more complicated it gets and the longer the deals. But I get it now with scaling it up and increasing the ticket size of all the investors. So I would say we've been really looking at project finance as a function, or the choices there as a function of friction to be able to scale up as quickly as possible. So I would say that's reducing friction is a key element we've been looking at. I think that the second one is a bit softer, but I do think it's important, and it goes for the operator, but also the investor. It's like a mutual understanding is that on the investor side, this is still very early stage, and therefore, there are certain risks involved that you wouldn't normally see, I think, in a more traditional project finance kind of deal. And the operator, I think, needs to be very conscious with that, and therefore also might take on more responsibilities or more of kind of results-based obligations than it might or you might see in more mature markets. And on the other hand, I think from the investors, these are, I'm talking about our own sector in this case, but these are very hard to reach areas where we do sometimes complicated things with very thin margins. So we can only go to site a couple times a year. Sometimes we can't even get to site because of the conditions to be able to get there. So just an understanding of that complexity, and therefore, it might not be as relevant or appropriate to talk about very tough liquidated damages on delays and stuff like that. So we'll have to model it in, but a practical and kind of flexible approach on penalties is, I think, appreciated, and much more solutions trying to be finding kind of how do we align incentives as much as possible. But there isn't a ton of room for penalties. Ultimately, those penalties are going to be paid by the end customer as well. So I think That was an excellent point on who pays ultimately for all the transaction costs, for all of the various kind of penalties. And that's, in our case, through the tariff that we have to charge our customers. And that growth of usage is also nonlinear, because at a certain point, if we can reduce our tariffs enough, you see a lot more productive usage of power in the sites, because the tariff becomes low enough for them to kind of make that business case out of it. And that's ultimately where we want to get, I think, on energy access, not just lighting, but true productive use of that electricity. So I guess that those are my key points to success, as far as we've been able to reach it.
Thanks so much, Tobias. It's fascinating to hear about the lessons you've learned. I think some of the common themes that are emerging, and also from the companies we work with, is reducing that cost and effort and resource allocated to fundraising, because operations are already difficult enough. And also there's an urgency in electrifying all the unelectrified households and businesses by 2030, both from a climate perspective and a development perspective. And so it's important to have these specialized lenders and investors to sort of lead the way, but eventually, they can help bring in also other capital to help you and other companies scale more rapidly. And now we'll turn to Gilles at InfraCo Africa, which has also been a partner to PowerGen, as Tobias mentioned. And InfraCo invests at various stages of productive use and household electrification projects across the continent. And it does have that overarching goal of poverty alleviation. And so I'm curious to hear from you, Gilles, about this Sierra Leone mini-grid that you worked on with Tobias and the PowerGen team, but also these landmark deals that have closed recently, including with Bonergie for solar irrigation in Senegal and with RVE Sol for mini-grids here in Kenya. So Gilles, please do share with us the key lessons that you've learned and what you've observed in these diverse transactions.
Thanks, Laura. And I'll maybe start with a clarification or a disclaimer, if you will. We're involved in earlier stages of businesses as an equity investor and a developer. Now, I would not have the pretension to say that we're developers. So we always say, with a certain dose of humility, that we're co-developers, because there's a lot of very talented developers out there, and with great ideas and great ventures. And so we really help those projects, if you will, at an early stage. And I think it's abundantly clear from the discussion so far that raising structured financing is hard work. It's specialized work, and it is typically something which can be done by organizations which have reached a certain maturity, if you will, and a certain capacity to engage into raising more structured financing. I mean, for anybody who's worked in large scale infra or your IPP type projects, all of these are very painstaking, very dogmatic, if you will, processes of raising capital, which are done by very mature organizations. But many of the projects or the developers we work with, bankability is their objective, but they're not there yet, and bankability is one of the biggest challenges, of course. And so I think one of the key lessons we've learned from all of these transactions we've worked on is flexibility, and that it always takes longer than one expected. And so really it's about working together with developers, helping them develop their businesses to a level of maturity, including management systems, governance, health and safety, putting in the right construction contracts, the whole structure, if you will, that will get them to a place where they're able to attract sort of the holy grail of cheaper and more structured financing. It's hard work. There's always obstacles, especially in early stage businesses. There are regulatory obstacles. There's tax. There's always something that pops up that needs to be dealt with. Disagreements between sponsors. And so I think flexibility has to be, I think, for me, the key lesson. Working through the difficulties that pop up, and really when I reflect back on some of the transactions we've been involved with, and I think Sierra Leone is a good example. Tobias would know. One of the reasons why the Sierra Leone grids that we worked on with PowerGen are up and running is because we decided that we'd go in as equity first, rather than try to raise debt, or we just hit the ground running, and then that's when you start to have something, assets, predictability, clear risk allocations, everything that you need really to be able to attract more structured and cheaper forms of funding. And so there's an urgency here that's been mentioned often. It's difficult really because if you want to have projects that are structured just right to attract debt, well, it's not going to work. So part of what we do is just to get to prime the pump and to get projects going on equity and bring them to a level that they are mature enough to start raising more debt.
Thanks so much, Gilles. I think you're absolutely right. Like if we wait for a perfect world, then we won't get there. And we have been building this ecosystem with investors and lenders and companies, and enabling actors like Power Africa taking different roles. And I do hope that we see increasingly, a number of players coming into the sector, again, led by actors such as yourselves and other speakers on the panel. Now, I'd like to turn our gaze a little bit more still into the future and really how we can make this work and how we can make this scale. So Surabhi, as you already presented, SunFunder has been one of the most active debt funders in this off-grid solar space, and working with a number of foundations and DFIs and other lenders to help really raise the sector in this past decade. So now, what do you see as the most critical challenges that are in the way of scaling? And is there a way that we can bring more standardization and more rapid scaling, or are we kind of still going to stay in this, every solution being bespoke and unique for a little bit longer?
Sure, thank you for that. I actually think the panel has actually touched on a lot of the different potential solutions there. And I think it's figuring out where do we start? What are the right priorities? You used an interesting word, standardization. For us, when we're looking at these transactions and looking at different deals and how do we put the structure in place, we're not trying to innovate and create something completely new. We're taking traditional banking products and we're adapting it to this sector, based on what country we're working in, what is their business model, but that, it is using those fundamental principles. One of the challenges that we've found is that there has been no standardization around how do we actually understand some of the operating risks. So for example, Gogla had a great initiative last year where they launched the KPIs for solar home systems. And we genuinely encourage companies to use those KPIs because it's something now that the investors understand, and it helps us in our due diligence process. I think the cross-boundary initiative with PowerGen, my hope eventually, Tobias, is that, the understanding of the revenue risk around these mini grids, I think that's been a critical challenge. And how do we actually standardize the metrics and understand the performance there? Because I think that will enable a lot of scale as well. So I think there's an element of that, of like, where there are similar risks, are there ways we can standardize understanding those risks to speed up some of the due diligence process? We pride ourselves on being quick and pragmatic, but we still have a fiduciary responsibility to our investors. So we do still need to understand these business models. I think the second is, when we're talking to companies, oftentimes they say to us, well, but you're an impact investor. This project is really impactful. And I agree. I mean, there are so many amazing businesses out there, but the fact is for your impact to be sustainable, your business has to be sustainable, unless you want to be not for profit, and that's completely separate. But so what is your path to profitability? We've come in where companies aren't necessarily profitable yet, but we see that they're actively working towards that and understand what they need to achieve. So I think that's, I think that there is an onus on businesses there. Local currency is critical. I think to date, the companies and the whole investor community has absorbed local currency risk. We've tried to work with commercial banks, and it's been quite expensive. We have a relationship with MFX and TCX, but unfortunately, they're one of the sole providers of this sort of solution in the markets that we're operating in. And I think we need more robust solutions, and also more optionality in the types of hedging solutions that are out there. Oftentimes, Gilles, you mentioned large project finance. Oftentimes you're looking at cross-currency swaps there, which is hedging an entire duration of a loan for in IPP space, 15 years. In our space, let's talk about 5 years, and that is not necessarily economical. So are there other hedging solutions, forwards, options that we can start thinking about and using, and investors can get comfortable with? And, everyone has touched on this. There is a certain level of scale that a company needs to achieve in order for structured finance to make sense, because there is the tax considerations, the regulatory considerations, the legal documentation. I mean, for us as an organization, we have in-house counsel to help reduce that cost. We do the drafting internally. We have an in-house engineer that reviews the technical risks of both construction and operations. We try to bring a lot of that in-house to really reduce the transaction costs with the borrowers and really take that pragmatic view. But I definitely think, one of the things when we were working on the transaction was, actually, I think for 3 of our transactions to date, we've leveraged Power Africa grants to help subsidize some of the legal costs that we've incurred. And I think there's definitely more scope for that. And then I think the final thing, and I know this is sort of off base from your original question, but I think it's important that, there's a lot of focus on the darlings of the space. It's easier to make the case for the leading companies, but as investors, if we want the space to scale, we also need to look at the second generation and third generation of companies. And, unfortunately, we're dead. And so as much as I want to do that, I look to the grant providers and like the KawiSafis of the world to also help us identify those companies, and as well as InfraCo, to identify those companies, get them to a point where, we can come in relatively early. And then of course there's the terms of dollar capital. And Samir, I wish we had closed 500 million already. It's a work in progress. We plan to close it early next year. But fundraising is ongoing. So stay tuned for that. So sorry, Laura, the short answer was that yes, it will continue to be bespoke, but there are ways that we can make it faster.
Excellent. Thanks so much, Surabhi. And on that note, I'll make a quick plug here for the financial modeling tool that was launched earlier this year by Power Africa Off-Grid Project. because that can also be a helpful way for companies to show their financial data in a uniform way, and also to understand their own business performance and communicate it better with investors and lenders. So that tool is available on our website, and we'll send it in the follow-up email to those of you who are on the webinar today. But really, really interesting to hear, Surabhi, your thoughts on local currency and how that's, really a required, tool in our toolkit. I think we've all been discussing it now for years, but definitely something to focus on in the coming years. And then on the concentration of capital and the focus on a few companies. In our network, we're working with over 400 companies across East, West, and Central Africa, different size, different technologies, different geographies. So for all the investors, lenders, and grant makers on the line, if you're looking for pipeline, you can always get in touch with us also for suggestions from our network, from our country advisors and regional advisors. Just a quick plug on our end as well. But now I do want to get to Amar, who is last but certainly not least. And KawiSafi's mandate is to provide growth equity to distributed renewable energy companies. And your portfolio does, in fact, include some of these, best household names, sort of largest companies in our sector. And so you've seen them grow, evolve, and mature. So I'd be keen to hear from you, Amar, what your recommendations are for companies in our sector who are looking to make their financing journeys a bit easier and a bit more affordable. And also, what can we do together as a sector to get closer to those structured solutions that Surabhi mentioned are already there in more mature industries and more developed markets? What are some of the options that we have?
Great, Laura. Thanks for teeing me up. And as for that pipeline plug, we'll be getting in touch. So look, first of all, first question, right? What are some of the pathways folks have taken? What does this look like? What are some of the tricks and tips, if you like, that have happened over time? As we were going through this whole panel, I was kind of circling words as well. I was kind of building a little word cloud. Simplicity, speed, risk, structure, scale, all things that we recognize as being incredibly important. I was really struck by the unified tone in all of the conversations about why all of these things. And I think the big why about all of these things is actually affordability. Affordability drives access to the customer. Affordability helps us meet that big goal of 2030 of universal energy access, and it helps meet that big goal of transition to a low carbon world. So just an awesome set of comments there that have come through, and I want to pick on each of those words in turn and just sort of talk them through around what makes this happen, right? What makes this journey happen? What have we learned along the way? So a couple of things, and I hope to be a tiny bit provocative about some of the comments that have come across over the course of the afternoon, but not too. There's discussion space here. First is about simplicity. Our first sort of port of call when we look at companies and we talk to them about financing and their financing journey is really to keep it simple. Find ways of really keeping it simple. We love that PowerGen just does on balance sheet recourse finance. I mean, this is like simple. This is the simplest kind of financing you can do is that, right? We get sometimes, I think, overexcited about SPVs and off balance sheet structures, et cetera, et cetera, et cetera. Every time you think about that, you think it may be bringing in some merits, but it does add complexity. So have a really good reason why you want to do off balance sheet, why you want to do something exotic, or why you want to do something strange. And I would say talk to the experienced capital providers in the market. I think SunFunder, folks around this table are some of the real experts in this space and can help guide you as you develop your financing strategy toward this. I mean, we've seen a bunch of companies now do the borrowing base act, and it's been really effective. So, don't reinvent the wheel, do it. Second word, risk. We all talk about risk, and I think my sort of insight on risk and my sort of advice and thinking around risk is understand as a company, understand risk better than your lender. right? So go to Surabhi, but know that you understand your risk better than she does. Otherwise, you won't have a constructive conversation, right? This is all about what your default rates are, how you break down the different cohorts of your business, the vintages of your business if you're in the lending world. What really is collateral that you can put on the table? How do you price that collateral? What's the return that you're looking at? And I think it was something Tobias said, how do you really align incentives around risk profile and get that return on risk that you can? But too many businesses don't understand what their default rates are, how many customers are going to pay, how many customers aren't going to pay. And these are the obvious questions that a financier like Surabhi will be asking. She talked about it in the context of SunCulture. But there's this idea of how do we build up a really deep understanding about the risk profile that we're presenting to our lenders and saying, look, we want you to back you against you. And very tightly linked to that risk question is then a horses for courses kind of piece, right? This is like apply the right kind of capital to the right kind of risk and have that thought through before you go out and have this set of conversations. I think folks like SunFunder will help you have these sorts of conversations. That's great. I think folks like KawiSafi will help you have these conversations. But this is about then saying a devco, right, where you're developing an overall business and you're building assets over time. That's venture type risk. And that's where KawiSafi comes in place. It's very expensive capital as a founder or as a employee or a shareholder in a firm. You're giving up equity because you're selling some equity to someone else. And that's the most expensive, most valuable thing you have when you're growing a company. So think about that, and then think about the asset codes, the predictable streams of revenue, the receivables that you have, and how you can tie those to debt. And those things should be cheaper. If you have US dollar denominated asset contracts, that's bankable, right? That's something that you can go out and get debt on, and you can look for ways of lowering the cost of your debt. If you look at a company like Redavia, borrowing base, $30,000, $40,000 assets. Each of those can be ring fenced. Each of those contracts is a 7 to 12-year contract. We can create borrowing structures that offer some predictability to the borrower and therefore start to push down the cost, right? So really thinking about applying the right level of capital, the right type of capital. All capital is different. And I would disagree a bit, I think, with the InfraCo kind of comments about using capital too early in the structure. I understand why we sometimes have to do that. We come in a little bit later, but you're giving away your earliest, most important capital when you're taking a huge amount of risk. So really thinking about how to use contracts and how to use your collateral to get as cheap capital as you possibly can, and running down these structured products is I think absolutely key. I wouldn't recommend using venture type capital for building up a big set of yield codes, put it that way. So that was the first question, right? What have we learned along the way? 3 pieces that I think we sort of slotted together there and we can reflect a little bit on. What's the second section, which is sort of how will this mature and how do we start moving towards slightly cheaper capital in the space? I think the first thing is just to reflect on some of the numbers that we're bouncing around here. We seldom see firms able to get debt in the single figures. We're often seeing double-figure debt, right? So in percentage terms, so coupons in the low teens or high 10, above 10. Below 10 is quite challenging, but if you can get debt below 10, that's fantastic. Look for ways of doing that, and again, think about the risk profile as you're going ahead. Recall that in a country like Kenya, treasury bonds. So sovereign-backed bonds will get you about 12% on the shilling, right? So be realistic about what your investors are going to expect. Obviously, US dollars will attract a different kind of rate, but your equity risk premium, like your base rate premium, is high when you're working in EM, and it's of course going to be higher if you're in early venture stage type businesses, right? You're testing a business model, you're putting new data into the market. So get realistic about what you think capital costs here. The expectation is that in a risky operating environment with a new business, you have to be more profitable. And We have to dance with some of those realities because, unfortunately, many investors say, where do I put my capital for the best risk return profile? And we have to understand that if we want to be able to attract a little bit more capital to ourselves. Of course, there's impact capital and philanthropic capital, and let's use that to our best advantage. But one thing I was reflecting on as we were coming into this conversation, I was thinking of the buy now, pay later bonanza that's happening in Europe and the United States. We've been doing PAYGO for the better part of a decade, right? Or at least 6-7 years. And so our community understands BNPL better than many of the most developed markets. And I was picking up a little article about Peloton, the little bicycle that folks have in their homes. A very smart bicycle that people have in their homes. It's very expensive. There's a buy now, pay later scheme that Peloton puts out. The bond issue that the company that runs that, they put that bond issue out at just over 1%. Right? So they're targeting very wealthy customers in the US with high FICA scores, so they know the credit history of those customers. That's pretty close to what the US federal bond rate was at the time that they put this money out. It's incredibly cheap capital. And imagine if we could have that kind of capital, how much of an accelerant it would be to our scale. But let's be realistic. Let's understand how they did that, what they're banking on. So I'd sort of say in this piece, what would be the recommendations? I think they would be the first set of recommendations. Keep it simple. Understand the risk profile, offer the right risk profile up to your lenders, and be smart about how you structure that. But I'd also say do what Surabhi, SunCulture, all of the guys around this table are doing, SunFunder, all of the folks around this table are doing. Build track record and scale, right? These two things together. As we do this, it will get cheaper, it will get easier, and we will find it that we can get lower cost capital at greater volume into this market because we're doing the hard work of building the capital. So when this all feels overwhelming and it's taken too long and we've run out of cash, I think there is this really strong sentiment out there. We are building something here. We're building a market. Take pride in that. This market is worth it. There are not that many shortcuts in life. There are certainly, from where I sit, very few shortcuts in this space. But I think, look, go SunCulture, go SunFunder, go Renewable, go cross-boundary. We can build this. Let's keep doing it, and let's keep building that transparency in the market. Thanks, guys.
Thanks so much, Amar. And I think the encouragement is well noted across the sector, especially for the entrepreneurs who are out there actually doing the hard work. I'm happy now to take a few questions from the audience. So you can continue to put your questions into the Q&A box. Even the ones that we don't have time to go through today, we'll read with great interest and hope to answer them in another forum or publication. But I will choose the first question from here from Max Jonsson, who's from the SIDA Power Africa team. So SIDA is the Swedish development agency and is one of Power Africa partners. And I'll give this question to Gilles, because Gilles, you're working in one of the least, the hardest places where there's the fewest people acting in those early stage equity transactions. So Max's question is, what can development actors like SIDA help to do to catalyze? So SIDA has, for example, had debt guarantees in the past, but what else would be, priorities, keeping in mind SIDA's desire to address poorer demographies, decent jobs, income generation, a lot of the same goals as InfraCo. So Gilles, I'll hand that to you.
So my answer would be to support funding, early stage development risk capital, because I think you always read about the same dilemma, the African infrastructure paradox, if you will, the dearth of bankable projects, and again, as I've said, there's a lot of very good projects, very good entrepreneurs, even in the most challenging countries. But it's sometimes a tall order in terms of capacity, not to mention capital. To develop a project well requires hundreds of thousands, if not millions of dollars of technical, legal, tax, environmental expertise. It requires people who forego salaries. Sometimes they can't forego salaries. So it's costly to develop projects. Yet, to bring them to a stage where they can start replicating, attracting financing, that's where you need the risk capital. And the private sector, I think it's a matter of perceptions also. There's this notion that African risk somehow is different than other risk. Because it's in Sierra Leone, because it's in Guinea, it must be very risky. And so there's a perception from private capital that early stage risk is sometimes too high. And that's where governments can come in and help, providing, more accessible, more abundant, risk capital, early stage risk capital.
Thanks so much, Gilles. Thanks for that answer. Tobias or Samir, do you have anything to add on what you would like to see development actors do to make your life and your fundraising easier?
Sure. Samir, you want to go first? I was happy to.
Go for it.
I'll try. Please add to it. I think I would strongly agree with Gilles. And I think to Amar's point is keep it simple. I think we would give the same message to funders. So I think the ones that work the quickest and are the easiest to kind of break this paradox, as you mentioned, is equity and grant. To be honest, is just the easiest one. And they often have the most direct impact on actually getting started, because I think we can easily get paralyzed, and they're all for very good reasons, whether it's local currency, whether it's, revenue risk, or whether it's like the geographies that we work. But if we do everything commercial, our tariffs are incredibly high, so the governments don't allow it. And ultimately, who pays for the total, all of the legal structures, all of, ticking all of the boxes of the various investors is the poor communities that we try to serve. So we can all kind of push it down to them, or we can try and find solutions along the way in terms of from the investors and financiers. And I don't think there's anybody better placed than donors to try and break that paradox by taking an imbalanced kind of risk and return approach to these early stage kind of projects, to get them on the ground, get scale, get data. Because even on a simple thing like data on performance of grids, there isn't a ton, at least in the mini-grid sector, right? Because people are not building, because people are, structuring various investments, trying to find local currency debt or a debt guarantee from a donor or whatever it is. Like, there are very straightforward instruments to break this, and it's equity and grant, I think. That might have been less nuanced than I intended to.
Just to add a bit onto that bit, Tobias, it's I find it funny that in every other part of the world, when you look at access to energy or the scaling up of any sort of agriculture productivity, subsidies have been used. Every grid in the world is 70 to 100% subsidized, but people get really scared when talking about the donor role in scaling these businesses, because we need 50 more SunCultures and 50 more PowerGens, and we need to all be doing 1,000 times more than what we're doing. And I think that there's an interesting role that development actors, specifically donors, can play when looking at replicating the success in other parts of the world. I always use the US example. In 1930, only 10% of US farmland was electrified, and 2 decades later, 90% of US farmland was electrified because of a subsidy program. So I think that there just needs to be a more coordinated approach to allocation of funds that I think can better help scale up these types of solutions. And I'm not talking about SunCulture and PowerGen and the types of companies that the investors on the call have funded, but in order to crowd in more people, because we're not going to reach our goals with just us. We need way more companies doing these kind of things, and we need to create we need to create more demand rather than just look at how do we build more on the supply side. And a lot of people try to match the supply and demand side, but I think you can start looking at demand generation in a different way. I know a little bit off topic a little bit there, but Tobias opened it up for me, so I figured I'd use that opportunity.
Yeah, thanks so much. So in short, between the three of you, I think having donors to take on some of that perceived or real risk and help to move quicker, whether it's through subsidy, which subsidies / grants or direct equity investments. The next question I'll take, since we are in a climate webinar, is from Christine Ebsinger. So she's asking to package these financings under climate finance. What do you think are the indicators or data that climate first investors need to see? And I'd like to give this to Amar, not to put you on the spot, but given that Green Climate Fund is one of KawiSafi's backers, I think it would be interesting to hear from you. How do you see that climate question, and what do we need to do to make sure that we also can tap into this climate financing stream?
Yeah, look, it's a great question. Thanks, Christine. Nice to hear from you, and let's catch up after. I think there's a couple of kind of straightforward things here, right? I mean, as we evolve in this space and we head up towards COP26, the world is watching, and we have a lot to give. We have a lot to offer. I think, Samir, your point about the US electrification, what does it take to really mobilize capital for the climate, is the same sort of scale that we need to see that we have seen in the history of some of our economies post-World War II, in the sort of bigger industrial transformations that we've seen in some of the rich world. And we certainly start to see some promise around that, right? So one of the things that we would encourage folks to do is really sit with and think about folks who are creating green bonds, concessional capital, allocating risk-based financing into this space. There is a significant amount of innovation, I think, that's happening around that, where we're able to direct capital at a relatively low cost back into this market. I think the broader question here is, what are the metrics we're using to align ourselves with those incentives to outcome, and how are we pricing those outcomes? How are we pricing those outcomes into the game? Carbon finance is clearly one space that's really awakening or reawakening after a fairly long period of dormancy. And I think all of us around this table are creative and innovative about how we're thinking about carbon finance and what that does to our business models, how we can capture carbon finance to push this forwards. Some of that will be hot air, right? But it doesn't mean it's not worth pursuing at this point in time. And all of us are here because we're used to the idea, or we're drawn to the idea of testing new markets and seeing if they can be productive and seeing if there's a way through them. So I'd encourage us all to just kind of keep pushing down that path. So the green bond piece, I think, is huge, potentially government sponsored, potentially large institutional capital sponsored, and we're getting closer to that space being real and pragmatic. There's some great bond arrangers out there that I think are doing some interesting work. And then the carbon finance piece, we could all sort of have lots of jousting matches about crypto and blockchain. Let's not do that during this call, but it does offer some innovation plays that I think are really valuable for us as we go forwards.
Thanks so much, Amar. The next question that I'd like to take is for Surabhi or Jemimah, and I think it's fitting that we close on a little bit of more of a technical question for this webinar. So this is from William Addo, who's asking, how does SunFunder structure SPV-based projects where the developer is requesting financing for a number of projects with limited collateral to support all the transactions, but has a high debt service coverage ratio? So he's saying that, structured financing would work best for corporate financing, where this lender can structure an asset-based or collateral-based financing. But how do you structure SPV-based projects? So copy the question into the chat.
Sure. Jemimah, do you want to take this one, or shall I? Okay,
you're on mute.
Oh, sorry. Yes, sorry. Surabhi, I think you can go ahead and take it. Yeah.
Sure. I mean, I think that's an interesting question, to say that you have a number of projects that you're not able to offer as collateral. And so that, to me, is the first question is, what is the business model? Like, trying to understand what is the challenge behind offering that as collateral. It's great that there's a high debt service coverage ratio, that there's revenues that we can look to and then that we can understand. But I think from our perspective of, yes, there's a, if we go back to that criteria, hopefully we can understand the cash flow, that there is an identifiable asset. And one of the keys is, how do we use that as collateral? And remember, we're debt, right? If something goes wrong, one of the questions that we ask ourselves is, how do we recover the value of that debt? If we go back to the borrowing base, the whole principle of having that discount is that essentially, if something goes wrong in the unlikely event, that there is a little bit of buffer for us. If we have to sell off the receivables to a third party to help collect, if we have to sell off the inventory, we might have to at the discount. There's costs to that recovery, but at the same time, we also have the conversation with ourselves that, for example, we did a transaction in Central African Republic. If something goes wrong there, the cost of Jemimah or myself flying to Bangui to collect a panel, to come back to Kenya and sell it is more than the cost of that panel, right? So we also try to be pragmatic about it. Like what is the true value of that collateral? So unfortunately, William, I don't have a clear answer for you per se, but I think it sounds really interesting, and it is something we would certainly look at to figure out if there is a way around this. Sorry, Jemimah, do you have anything to add to that, or?
No, Surabhi, I don't. I think you made the point, yeah.
Thanks so much, Surabhi, for that answer. And William, you can always reach out to SunFunder to explore this more. With that, Shane, if you could give me the next slide, please. So with this, as we're almost at time, I'd like to bring our webinar to a close. And on behalf of Power Africa Off-Grid Project, I'd like to really thank all of our speakers and audience members once more for your active participation and interest today. As you close your Zoom, there'll be a very short survey that we hope you take the time to answer. And we also hope that you'll be in touch with us in case you have questions relating to the off-grid space in East, West, and Central Africa, or across Sub-Saharan Africa, and we can refer you to more Power Africa partners. So the email address here is the Access to Finance email address at Power Africa Off-Grid Project. If you are a developer, an enterprise, a lender, investor, or donor interested in the space, we invite you to be in touch. I'd like to thank Lovemore again for his remarks and for Power Africa's support. And with that, I'd like to say thank you and have an excellent evening or day, depending on where you are. Goodbye.
Thank you very much.
Thank you so much.
Thanks. Bye.